Welcome to This Explainer. Today, we're going to decode a concept that, honestly, gets misunderstood all the time. We're talking about how to actually figure out if a stock's price is an attractive deal or just terribly expensive. We'll be unpacking these incredibly powerful tools called multiples to help us see right past the ticker price. Right off the bat, let's look at a really common illusion. Think about it. Is a $10 stock actually cheaper than a $100 stock? Our human intuition just screams yes, obviously. But in the world of finance, a share price just sitting there in isolation is practically meaningless. It literally tells us nothing about the underlying value of the company. To find that out, we're going to need a bridge. And that bridge is what we call a multiple. Think of a multiple as your financial translation device. It's essentially a ratio that takes a stock's price and compares it directly to fundamental, real-world metrics like earnings. It strips away the illusion of the share price entirely and reveals exactly how much we're paying for the actual economic engine of the business. So, here's our roadmap for mastering this today. First, decoding the price tag. Second, the PE ratio explained. Third, looking back versus looking ahead. Fourth, context is everything. Fifth, beware the value trap. And finally, the golden rule of investing. Moving right along to section 2, the PE ratio explained. The math here is actually beautifully simple. It's just the stock price divided by the earnings per share. But conceptually, I want you to think of it like you're buying a machine that literally prints dollar bills. This formula answers one massive fundamental question: how much am I paying upfront for every single dollar this machine generates in a year? Let's ground this with a quick hypothetical. Imagine a business called the_FinPro Co. Ltd. Let's say the stock trades at $40 a share, and there are exactly 1 million shares out there in existence. Now, over the last year, the company made a net income of $2 million. If you spread that $2 million in profit across the 1 million shares, our earnings per share, or EPS, comes out to exactly $2. So, taking that $40 stock price and dividing it by the $2 in earnings per share gives us 20. That's it. That is our PE ratio. It means investors out there are willing to pay 20 times the company's earnings to own a piece of it. To put that into perspective, if the company's earnings stayed exactly the same forever, it would take 20 years for the company to earn back the price you just paid for it. All right, let's jump to section 3, looking back versus looking ahead. When we look at PE, we actually have two very different lenses we can use. One is the trailing PE, which looks at the past 12 months of historical earnings. This is factual, it's concrete, and it's totally backward-looking. But then we have the forward PE, which uses forecasted earnings for the next year. Now, this reflects market expectations, which honestly is what investors usually care about most, but it inherently relies on predictions. So knowing which lens you're actually looking through is absolutely vital. Which brings us perfectly to section 4, context is everything. Because a multiple like that 20 we just calculated doesn't mean anything in a vacuum. You have to benchmark it in two specific ways. First, you compare the current PE to the company's own historical average. Is it trading cheaper or more expensive than it usually does? And second, you've got to compare it to industry peers. Think about it. If the company you're looking at is at 20 times earnings, but every single direct competitor is sitting at 15, you have to stop and ask yourself why you're paying such a premium. You see, different sectors live by entirely different numerical rules. High-growth sectors like tech, for instance, naturally command much higher multiples. Why? Because investors are pricing in explosive future earnings. On the flip side, mature industries like utilities offer steady, rock-solid reliability, but much slower growth, so they trade at lower multiples. Comparing a high-flying tech company's PE to your local utility's PE is honestly like comparing apples to bicycles. It just doesn't work. And we can't forget about market psychology because it drastically impacts these numbers. Let's talk about multiple expansion. This happens when the stock price goes up, even as the actual earnings stay flat or fall. The market is just feeling overly optimistic, so you're essentially paying more money for the exact same amount of profit. It's kind of like paying a massive premium just for the hype of getting a front row seat. Multiple contraction is the exact opposite. Pessimism takes over the market, and investors assign less value per dollar of earnings. These movements are effectively taking the emotional temperature of the entire market. Okay, let's head into section 5. Beware the value trap. This is huge, guys. Chasing low multiples blindly will lead you straight into a value trap. This is when a stock appears incredibly cheap because it has a really low PE, but the price just relentlessly keeps declining. Why? Well, the multiple's low because the underlying business conditions are actually deteriorating. We're talking about maybe a dying industry, crushing debt, or margin-destroying regulations. Sometimes a low PE isn't a discount tag at all, it's a blaring warning siren. And that leads us to our final part, Section 6, the golden rule of investing. So pulling all of this together into a practical, professional approach. Step 1 is absolutely not find a low multiples. Step 1 is identifying companies with fundamentally strong, durable business models. You have to start there. Only then, in step 2, do multiples come in to help you assess if the current price is fair relative to its benchmarks. And finally, step 3 reminds us that multiples are really just an initial gauge. You absolutely must combine them with a deep, thorough understanding of what the company's future actually looks like. I think Warren Buffett summarizes this entire philosophy just perfectly. He famously said, "It's better to buy a wonderful company at a fair price than a fair company at a wonderful price." Think about that. A wonderful price simply cannot save a dying business. But a fundamentally wonderful company, that is very often worth paying a fair or even slightly elevated multiple for. So I want to leave you with this final thought today. The very next time you pull up a stock chart and see that price, ask yourself, are you just bargain hunting for a fair company at a wonderful price? Or are you investing in a wonderful company at a fair price? Because mastering multiples is exactly what allows you to confidently spot the difference. Thanks so much for joining me on this explainer. Keep exploring, and I'll catch you on the next one.